Elon Musk once said, when something is important enough, you do it even if the odds are not in your favor. Beating all the odds in these tough times, IIM Amritsar is ready with its second conclave of this academic session. Good evening to all here. I, Jill Makani, and Rajat Agarwal from Industry Interaction Cell welcome you all to the fourth edition of Pariprekshya', the annual finance and marketing conclave of IIM Amritsar.
Pariprekshya'20 is a horizon for the subsequent managers of IIM Amritsar to meet the industrial stalwarts who have the expertise in the domain of finance and marketing and have also put forth exemplary strides in these domains. Today, on the 3rd of October, we have the finance panel discussion with eminent leaders in the venture capital domain. Before starting with the event, I would like to call upon Mr. Krishna Swaroop from MBA 06 of the Placements Committee of IIM Amritsar to get you all acquainted with the journey of IIM Amritsar so far. Krishna, over to you.
Thank you so much, Rajat. Is screen sharing enabled? Could you please enable it?
Request media and PR team to kindly give rights to Krishna.
It's still not on. Okay, while it's taking time, let me just tell you what I'm going to be doing here. First off, I hope you're all staying very safe and healthy. Thank you so much for joining us today for Pariprekshya'20. I will be taking you through a journey of IIM Amritsar through the past 5 years since its inception. So now it's enabled. Let's get started. Okay, I hope my screen is visible to everyone. Yes?
Yes, Krishna.
Yes, Krishna.
Okay, thank you. Thank you. So, as you may know, we are the 15th IIM that has been set up by the Ministry of Human Resources and Development. We were under the mentorship of IIM Kozhikode until our first director joined office, which was last year. On the 6th of August 2015, we inducted our first batch, the MBA 01 batch. As you may be well aware, we are in the land of the Golden Temple and the Wagah border. So we definitely benefit from the enriching experience that's been offered by this oh so holy city, for sure. We are currently established in the Punjab Institute of Technology building, but our very own campus is under construction as we speak. We have state-of-the-art facility in whatever it is that we do. We follow the same pedagogy as is adopted by IIM A, B, and C, some of the prestigious members of the IIM fraternity. We have state-of-the-art IT-enabled classrooms, a digital library, a Bloomberg index. We have everything that a potential B-school student would ever need. We are also in possession of some of the most highly qualified and coveted faculty from B schools across India. B schools along the lines of IIM A, B, C, IIM Indore, XLRI, IRMA, MDI, etc. We also have the largest batch size. We have the largest batch size amongst all of the 3G IIMs. We have 146 students in our MBA 05 batch, our current seniors, and we have 207 students in our MBA 06 batch. So the thing that IIM Amritsar aims to do is not just imbibe financial or business education inside every single one of you. It's also to mold the managers of tomorrow holistically. So when the students take part in various club and committee activities, it results in their winning many corporate and B-school competitions, which leads to more of their development, which leads to them being capable of tackling all of the business challenges. Now, let me take you through some of our student achievements so far. We have the winners who bagged the first position in Investo Finesta at IIM Nagpur. We have the winners who bagged the first position in Kratos 2020 at the Indian Institute of Foreign Trade. We have the winners of Mark Shastra, which took place at IFMR Graduate School of Business. We have the winners of the Go Crack It Pan India Challenge, the 12th edition of the same. We have the winners of OnePlus ET Prime Intellect in our college. As for the national finalists, we have the national finalists of Tata Crucible, which was the campus quiz that happened in 2020. We also have the national finalists of Prudyogiki, the analytics case study competition at IIM Rohtak. We also have the national finalists of the Credit Research Challenge, which was organized by the International Wealth Management of India. We also have the national finalists of the Smart Beta Valuation, which took place at IIM Rohtak. We also have the second runner-ups of Arthashastra, which was the policy-making competition held at IIM Kashipur. So the event timeline that we have been having through the past 1 year. on the 15th of July 2019, we inducted our MBA 05 batch. On the 10th of August 19, we had Yukti 19, the annual HR conclave. On the 12th of October 2019, we had Pariprekshya' 2019, the annual marketing and finance conclave, the 20th edition of which you were all a part of today. On the 9th of November 19, we had Sankshetra, the annual strategy and operations conclave. On the 7th and 8th Feb of 2020, we had Arunya, the annual management, cultural and sports fest of our institute. On the 7th of March, we concluded our summer placements of MBA 05 batch. We are very proud to say that we successfully concluded 100% summer internships for every single student in the MBA 05 batch. On the 10th of March 20, we concluded our final placements of MBA 04. Once again, we successfully concluded 100% final placements to all students in MBA 04. On the 30th of May 20, we launched Avlokan, which is our flagship leadership webinar series. We have been fortunate enough to be graced by 20 industry experts so far. On the 13th of July 2020, we started with the new mode of online MBA curriculum. On the 30th July 20, we were inducted the MBA 06 batch. On the 8th and 9th August of 20, we had Yukti, the annual HR conclave, its 20th edition. Let me take you through a snapshot of the summer placements of MBA 05 that happened this year. So we had 146 total students, all of them placed on campus. 48 number of recruiters came to hire them. The highest stipend that was offered to them was 2.5 lakhs. The top 50% of students bagged packages of 95,000, and the top 25% of students bagged packages of 1.3 lakhs. The average stipend was 62,572, all for a course of 2 months. As for the final placements of MBA 04, to provide you with a snapshot of the same, 106 total students were there. We had 11 number of pre-placement offers. All of them were placed. And we had 21 first-time recruiters who joined us. The highest domestic CTC that was offered shot up to 40 lakhs. The top 25% of students bagged packages of around 18 lakhs, 17.8 lakhs. The average CTC was 12.6 lakhs. To give you a batch profile of MBA 05, 46% of MBA 05 batch consists of freshers. 23% of them have work experience in the range 12 to 23 months, and 18% of them have work experience in the range of 24 to 35 months. As for their work experience and domains from where they're joining us, we have 40% of MBA 05 who have been involved in IT services or IT consulting. 20% of them are joining us from the manufacturing sector. 12% of them are joining us from sales and marketing. 11% from operations and analytics, and we also have several others as well. As for MBA 06 batch, our batch profile, 55% of us are freshers. 16% of us have a work experience between the range 12 to 23 months, and 11% of us have work experience between 24 and 35 months. As per our work experience and domains where we hail from, we have 45% of us who are coming from IT services, 10% and 10% for operations and manufacturing respectively, 9% from finance and audit advisory firms, and 8% from strategy and consulting. We also have students from sales and marketing as well as other domains as well. Here is our placement calendar. We have already begun with our pre-placement talks, which started in September and will conclude in November. We are currently underway with our summer internship process, which will generally happen around October of every year. Our final placement process for MBA 05 will begin in November 2020. Now, we are extremely proud to say that we are almost entirely a student-run campus. We have committees and clubs for practically everything. So some of the committees that we have are the placement committee, the students' council, the sports committee, the merchandising and sponsorship committee, the media and public relations cell, the industry interaction cell, the hostel and mess committee, the cultural committee, and the alumni committee as well. And some of the interest groups that we have, we are very proud to say that we cater to every interest of every B school student. We have got both academic as well as non-academic interest groups. So under academic, we have HITWI, our Human Resources Club. We have Marco Philic, our Marketing Club. We have Operazil, which is our Operations Club. We have Finance and Economics Club, the FEC. We have Stratagem, the annual the Strategy and Consulting Club of IIM Amritsar. We have the Center for Entrepreneurship, COE. We have the Analytics and Business Computing Club, the ABC Club. We also have a full-fledged photography club called 50mm. We have Sankalp, which is our social services wing. We have Vani, which is our literary and public speaking club. all in all, when it comes to the end of the day, what I Am Amritsar does is we are empowering talent every day. And this can only be accredited to our talented students and our efficient professors, and also to our rich industry connect, which we've been fortunate enough to hold for so long. And this is only possible because of the constant support from the industry. I'd like to conclude by saying that with a past studded by the achievements, corporate wins, and B School laurels brought home by its students and faculty, IIM Amritsar promises to strive for excellence every passing day into the future. In a true sense, we are the playground for dreams to see the end of day, for personalities to flourish, and for careers to change the world. Thank you very much for your time. Have a great conclave.
Thank you, Krishna, for giving us a glimpse of the beautiful journey of I Am Amritsar.
Thank you so much.
Now, I would like to call upon the young members of I Am Amritsar family, Ishika Agarwal and Harshit Ahuja of MBA 06 batch, to apprise everyone with today's theme, Future of Venture Capital Activities. Over to you guys.
Thank you, Jill, for the introduction. Harshit, can you just start sharing the screen?
Yeah, sure. It has been disabled. Can you please check?
Request MPRC team to give them rights, please.
It's visible now, Harshit.
Okay, thank you. So very good evening to everyone present here. I, Ishika Agarwal, and my teammate Harshit Ahuja will take you through the future of venture capital activities, the finance theme topic of Pariprekshya' 2020. We live in a dynamic world. Everyone is changing rapidly around us. Similarly, there have been shifts in the emerging trends and the way the venture capital investments used to function. Moreover, we are not unaware of the far-reaching implications that the pandemic has upon us. Major economies are falling. There have been significant shifts in the stock market. Similarly, we see investments are no exception to it. So through this presentation, we'll see some of the prospects of VC activities in future.
Yeah, thanks, Ishika. First, we will try to understand what venture capital actually is. So, venture capital is a form of private equity financing provided to the startup businesses. And these businesses are believed to have long-term growth potential. Although venture capital investments involve high risk, but this risk is compensated by high returns which investors get in turn. Now, we will briefly take a look at the various stages of venture capital funding. But first is the seed stage, where a business has an idea, to the startup stage, when a business comes up with the prototype of the product or service. Next is the first stage, when it introduces the product in the market. And then the expansion stage, where the business is looking to expand its market and it needs financing to carry out that. And finally, the bridge stage. It is looking for financing to carry out merger and acquisition or IP-related business processes.
Starting with the present condition of the VC deals, funding fell to just 3.7 billion in the first quarter of 2020 from a record high of 6 billion in the fourth quarter of 2019, mostly due to the economic uncertainty around COVID-19. Secondly, 75% of the founders had a favorable funding experience in 2019. Now 58% of them expect fundraising to be more challenging. Lastly, VC firms are asking startups to not roll out any new products and freeze any business expenditure. Businesses have to increase their runway by 15 to 20 months. Clearly, the priority of investors is to help our current companies. So coming to the next slide, diving deeper into the nature of the shift that the VC deals have taken, we see a huge increase in distressed investments as companies begin to run out of cash and investors trying to save their current investment losses. Second, we also see a huge increase in philanthropic investment as government and not-for-profit organizations work with businesses working on potential vaccines and treatments. Series A deals have been the worst hit so far, whereas Series D are likely to be the least impacted, with VCs preferring to back already established business models. Next, since global VC investors are sitting on nearly 189 billion of dry powder, and this is giving the entrepreneurial ecosystem some hope, they do not have the luxury to sit on the fence forever, as this would impact their timelines and the ongoing funds. Next, As companies struggle with their cash flows and profits in the coming future, the valuations are likely to be reduced by 25%. Companies are looking to divest from their non-core business activities and invest in their core business activities. The new normal business models will become the new deal breakers for VC investing. Given travel and movement restrictions, cross-border VC investment will be very challenging. And lastly, since investors have become more risk averse, therefore, they have further sought to protect their investments by securing veto powers and strengthening the operational control. Now, VC will most likely increase their hold periods and work through the crisis to sell in better times rather than by selling at significantly discounted valuations. Their investment horizons have increased from 5 to 7 years to 8 to 10 years. So here are some of the ways through which they're going to deal with it. Firstly, they'll be ready to sell their short-term investments to increase their liquidity in the current scenario. Secondly, they would be seeking out opportunities to provide bridge financing to businesses facing short-term working capital requirements. Lastly, they can conduct liquidity stress testing and scenario testing to see if an institution has enough funding resources to withstand the market disruption. Now we all know that the VC investment have taken a hit in the first and the second quarter of 2020. However, the long-term outlook looks promising. Firstly, because of the long-term growth potential of India as a developing country, the current economic slowdown is seen as a cyclical one and not structural. The government of India has also promoted a lot of homegrown startups through various schemes and policies. Next, since investors have become suspicious of the type of investments they'll make in future, they are resorting to convertible bonds and special situation funds. India's revised FDI policy is likely to hurt startup investments as major Indian startups like Ola, Make My Trip are funded by Chinese VC firms. Long-term growth strategy of patient venture capital investors is coming handy in these tough times. Now, in this slide, we would like to mention some of the long-term parameters that the venture capital firms will look before investing in a startup. Firstly, does the company have policies and procedures to minimize the risk of infection among its customers and employees? Are there barriers to successful remote working? Secondly, is the company having enough profits to pay its interest and debt? Are the creditors of the company ready to increase the repayment periods? Third, are the customers or suppliers based in the riskiest area? Is the supply chain vulnerable to disruption? Is the revenue dependent on travel or by social distance? Long-term risk involve any shift in government policy, changes in patterns of global trade, or permanent change in consumer preferences. Lastly, is the company or its business model vulnerable to reputational and cultural risk?
As we know that most of the business segments are hit badly by this unforeseen pandemic, but there are some segments which are flourishing in these times as well. And one of the KPMG report explains that this pandemic has forced consumers to embrace the new behavior, and these behaviors are potentially long-lasting. Now, from the investors' point of view, VC firms are now more interested in investing in those businesses which are digitizing their current business processes. Now, these booming sectors are pharmaceutical, consumer tech, fintech, entertainment, gaming, virtual meeting, and e-learning. In these sectors, we have already seen a significant rise in investment from 2018 to 19, and this pandemic is fueling it further in 2020. In consumer tech segment, Ola, Farmizi were the major players which got investments in fintech. This is driven by $1 billion deal by Paytm, and in B2B, Udan has garnered one of the major VC deals. Now, coming to the e-commerce players that are getting funded by venture capital firms, there is a major shift we can see over the years in the type of startups which are getting funded. From 2012 to 2015, horizontal e-commerce businesses, which essentially means they are selling products from a large number of categories. The examples of these businesses are Flipkart, Snapdeal, and Shopclose. From 2016 to 18, the vertical e-commerce firms, which are into specific product or service, emerged, and these vertical businesses include high engagement, high frequency segments like beauty and grocery, etc. And examples of it are Book My Show, Nika, are there. From 2019 onwards, new e-commerce models emerged, and these models, which are in line with the new normal businesses, are getting funded. These include urban company, grocers, and Lenskart, etc. Now, delving deeper into the consumer tech segment, here we have a significant rise in investments from 2018 to 19 by $1.6 billion. Looking at the subsegments of consumer tech, first is the edtech, which is essentially online learning platform. Here, Unacademy and Byju's received the VC investments. In mobility, this segment is primarily driven by electric vehicles such as Ola Electric. Third is the food tech, which is driven by online food ordering and cloud kitchen. Here, Rebel Foods, Box8, InnerChef are some of the players in these segments. Finally, the health tech segment. Here, early stage telemedicine and e-pharma platforms are getting funded by VC. Now, we'll look at the role of technology in the VC industry. As we see that the technology is simplifying and speeding up each and every business process, and venture capital decisions are not different from it. Here, a machine learning model is developed, and this model generates investment recommendation considering various factors such as conversion rates, total money raised in the past, etc. So the question is, how does it work? This model draws data from the sources such as Crunchbase and PitchBook. Then it identifies the special characteristics for the seed deals. And all in all, we can say that technology is not solely responsible for the VC decisions, but it actually augments VC decisions once we integrate it to the decisions made by human investment team. Next comes the fronts where technology comes handy in VC decision making. So these are, it helps in investors spotting market gaps and general trends, in matching co-investors in deals, obtaining intelligence on competitors' landscape, and last and most importantly, creating more accurate valuation models.
Therefore, the last 2 decades, we have seen the rise of venture capital to become synonymous with innovation and wealth creation. The full impact of the pandemic on VC funding has started to play out, with the deals deferred, term sheets withdrawn, valuations down, and the new models shaping up. While traditional VC investment is expected to slow significantly over the next quarter, there are niche segments of the market that could remain attractive to investors due to their applicability in the current environment. Health and biotech to be quoted for the example. Therefore, we go through 2020 with record high levels of dry powder, counterbalanced with caution and an underlying optimism in the long-term potential for the ecosystem. On this positive note, we would like to close our presentation. Thank you everyone for listening to it so patiently.
Thank you. Thank you, everyone.
Thank you, Ishika and Harshit, for this well-covered presentation and setting up the right context for today's discussion. Now, without further ado, I would like to introduce you all to the speakers for today's event. I take immense pride in introducing the moderator for the day, Mr. Umesh Kudalkar. Mr. Kudalkar is a passionate investor and a CFA charter holder having a master's degree in financial management and mechanical engineering. Mr. Umesh is a venture capitalist as well as public equity market investor with more than 30 years of experience in corporate finance, venture capital, and private equity. He has also made some very successful venture capital investments in robotics, aviation electronics, and products in India. Currently, Mr. Umesh is the director of Multi-Act Trade and Investments, which is a global equity research and portfolio advisory firm. He offers advice on fintech investments for Multi-Act Private Equity Investment Trust, a SEBI Category 2 alternative investment fund. He has also held senior management positions such as CEO of Secom Capital Management and Chief Investment Officer of Serum Institute of India. We are very delighted to welcome Mr. Umesh for today's discussion.
Moving on, we have with us Mr. Amitabh Sinha, the co-founder and CSO of meetingsandoffices.com. He's a serial entrepreneur, startup evangelist, mentor, ecosystem builder, and facilitator active in the startup domain since 1999. In a career spanning more than 25 years, Mr. Amitabh has worked across domains as diverse as consulting, international trading, manufacturing, brand communications, venture capital, financing, and industry representation. Mr. Sinha's areas of expertise lie in business logic, business strategy, GTM, frugal growth, low or no cost marketing, community building and management, and leadership. He has been associated with the SME Chamber of India, Startups Council of India, and Packaging Industry Association of India in honorary roles, evangelizing industry, creating facilitating networks, and expanding small industry footprints. Mr. Amitabh is also a frequent speaker at various fora and talks on a variety of subjects. Next up, we have Mr. Chenu Senthil Kumar. Mr. Chinu is a general partner and CTO at Exponentially Venture Partners, which is a VC fund emphasizing on US India corridor tech startups. Along with Infosys ex CFO and Wipro ex CEO, Mr. Chinu co founded Exponentially Venture Capital Fund, focusing on cutting edge technology startups focused on AI, machine learning, computer vision, cloud infrastructure, and IoT. Prior to Xfinity, for about 20 years, Mr. Chinu held progressive technology executive roles in Intel, SanDisk, and Texas Instruments, both in the US and India, and held 9 US patents to his name. In the capacity of SanDisk country head, Mr. Chinu spearheaded SanDisk India operations in the areas of R&D, operations, and IT outsourcing. Mr. Chinu is an innovator from a young age and has received the National Technology Award from the President of India at the age of 21. His articles are widely published in Hindu Business Line, Economic Times, Forbes, Financial Express, and Swarajya. He hails from an agricultural family background, and in his spare time, he takes keen interest in agricultural related topics. Mr. Chinu received his master's from University of Utah, which is in Salt Lake City, US, and he has done his BE from College of Engineering, Guwahati, Chennai.
Next in line, we have Mr. Mitesh Shah, the CFO at Book My Show and co-founder of Inflection Point Ventures. Mr. Shah began his career with Mandhana Industries Limited, an manufacturing company, where he handled crucial projects like successful launch of IPO and global license deal with Being Human in 2011. In the past, Mr. Mitesh has served as CFO in Ola. Thereafter, he joined Book My Show as CFO, where he spearheaded the finance function and played an active role in strategic business management. With his vast experience in the startup world, nurturing and guiding startups have always been his passion. So, to contribute to the startup ecosystem growth and also follow his passion, he co-founded Inflection Point Ventures in 2018. IPV is one of the largest angel investment platform in India with 2,800 plus members, which works towards helping quality startups connect with CXOs and professional angel investors. A commerce graduate from Mumbai University and a chartered accountant of 2001 batch, Mr. Mitesh has also pursued a diploma in information system with ICAI in 2002. Next up, we have a very famous personality, Mr. Minad Karpe, with us. Mr. Karpe is a partner at 100x.vc, a VC firm that invests in early stages startups using the pioneering model of iSafe notes. 100x.vc is the first institutional investor in its portfolio companies and aims to invest in 100 startups every year. He was the chairman of Western Region of the Confederation of Indian Industries for 2017 and 18, an honorary position. Mr. Karpe is the director of Aptec Limited and has also served as the MD and CEO for more than 7 years. He has also served as managing director at CA Technologies. Earlier in his career, Mr. Karpe worked as a consultant advising companies seeking to invest in India. He is a frequent writer and speaker on business strategy and has also delivered at a TEDx event. Mr. Ninad has also authored a book on business strategies titled Born to Baba. His 20 minutes live web broadcasts with reputed personalities garnered a wide audience. Besides his day job as a VC, Mr. Karpe is an avid Formula One fan and also passionate about supporting theatre, where he has also co-produced 2 Marathi plays.
Next up, we have Mr. Sanjay Chaturvedi. Mr. Sanjay is the CFO at Hellion Ventures and the Fundamentum Partnership. In his current role, Mr. Sanjay heads the finance, operations, investor relations, and legal functions of Hellion Ventures and the Fundamentum Partnership. He also works closely with the investment team in diligence and closure of new investment opportunities. Post-investment by the fund, he engaged with startup founders and finance team to help with scaling of the finance function. He was global CFO and managing director of a capital market research outsourcing startup, Amba Research. He played a key role in building the startup from scratch, its global growth, and a successful exit through an acquisition by Moody's. Mr. Chaturvedi has also held senior finance leadership positions with Fortune companies like Pepsi, American Express, and GE. He's a graduate from the prestigious Sri Ram College of Commerce, and he's also a chartered accountant. We'll now wait for the guest to join the meeting.
We have our guest with us. I can see Mr. Umesh.
Hello.
Good evening, sir.
Hello. Good evening, all. This is Sanjay Chaturvedi here.
Hello, sir. Good evening.
Good evening to everyone. This is Chinu here.
Hi guys, Amitabh Sinha here.
Hello, sir. We also have Mr. Mitesh with us, and we are waiting for Mr. Ninath to join us.
I've joined Ninath Karpe here.
Okay.
Hello,
Very
sir. Good evening, sir.
Good
Do
evening.
we have Mr. Mitesh as well?
Here I'm here.
Okay.
Hello, sir. Good evening.
Good evening as well to you.
Thank you, sir.
Warren Buffett, one of the greatest investors of all the times, once said, I quote, "Made my first investment at age 11. I was wasting my life up until then." Unquote. Investment is that fuel in the car of businesses without which the economy cannot move. Respected director, our esteemed guests, faculty members, and the students of Indian Institute of Management, Amritsar, a very good evening to all. I, Rajat Agrawal and Jill Makani, would like to welcome you all to the 4th edition of Pariprekshya', the annual finance and marketing conclave of IIM Amritsar. Learning has always been a juggernaut that keeps the paddle of success moving forward. And what could be a better platform for the brightest minds of the industry to come together and enrich the students with their epitome of experiences?
A good leader is one who knows the way, goes the way, and shows the way. And IIM Amritsar finds itself really fortunate to look up to such an inspirational personality, our director, Professor Nagarajan Ramamurthy. I would now request you, sir, to kindly address the August gathering. Over to you, sir.
Thank you. Greetings and good evening. This is one of those years which is not a normal year. It's one of those years where we have had this disruption. What might have started as a Vision 2020 has sort of become a nightmare 2020 for us, where we don't know, right, when this uncertainty is going to end. It has caused havoc for us in a variety of fields, in employment, in business, in economic activities. It has been a medical challenge, and many near and dear have, my friends and others have lost their near and dear. Given these type of uncertainties that we have had, most of us are just presently focused on what is today, what's happening today. But this also has posed a financial challenge for people who are close to retirement, or those who are expecting that the retirement, they have had enough savings and whatnot. Where the financial markets has had this topsy-turvy ups and down for the past few months. The reality is that we don't know when it is going to end. We see about unlockdown around the world, and again, going back to lockdown and closing down, and whatnot. Now, why many people may really look at this as a challenge or threat, I also would like to look at this as an opportunity. How are the venture capitalists doing? Which are the industries or sectors that are growing? Which are the industries or sectors that have had innovation, right? Where people like the esteemed dignitaries that are with us today have been, are investing their money. One of the other things that I want to emphasize is that this is also the second edition of this year's Conclave, where we are partnering with CNBC TV 18, which will be telecast, at least the highlights of this event will be telecast in the next couple of weeks. Other than that, our students of IIM Amritsar and our faculty have also been facing this challenge, not financially as much, but in terms of the educational opportunities. This crisis that is going around us may have broken some of the normal activities, social life, educational opportunities, employment opportunities. I am sure that many of my students are equally concerned that what's going to happen to their placement, in the next few months, because they invested their time and effort and money, hoping that they can really get something in return right when they graduate. They are trying to build their life. One thing that I can proudly say is that for the IIM Amritsar community, students, faculty, staff, it has not broken our spirit. Initially, I was very concerned, when this epidemic started, or pandemic started, what are we going to do with all these conclaves and other cultural activities? Because education to me is not simply like, what you go to the class, listen to the lecturers or do some homework or take tests, right, you get a grade. So that's only one part of it. The other part of education is like, a holistic development of people, how it is going to help them shape their personalities. And that integral part of the holistic education is the interaction with industry, experts like you, who have had something that we cannot teach them in class, but that you have acquired over the years through hard work and experience. I can proudly say that, the first conclave was organized by the students. Actually, the second year students started the class on August 3rd and with August 8th or 9th in both the first year students and second year students together were able to pull this off. And then within the next 6 weeks or 7 weeks, we have our second conclave that has also been successfully organized. Most importantly, what it shows is that these type of crises that we face are passing by crises. In other words, they are not going to last forever. It shapes our personalities, it shapes our will, it makes us stronger. I am sure that the economy as well as our lives will return to normalcy, if not in the next month or two, but maybe 6 months, right, or 8 months. But then we will actually emerge stronger out of this. Now, I would like to thank all the panelists who have agreed to be part of this process of providing the holistic education to our students, and request them to enlighten our students and faculty in terms of their real life world experience and share them with us. Thank you very much.
Thank you, sir, for your enlightening words. So now, without further ado, I would like to steer the conclave towards the discussion on the theme Future of Venture Capital Activities by introducing our guest. First of all, we have Mr. Amitabh Sinha, who is the co-founder and CSO of meetingsandoffices.com. We have Mr. Chinu Senthil Kumar, who is a general partner at Exponentially Venture Partners LLP. We also have Mr. Mitesh Shah, who is a CFO at Book My Show and co-founder at Inflection Point Ventures. We have Mr. Ninad Karpe, who is partner at 100x.vc. We have Mr. Sanjay Chaturvedi, who is CFO at Hillian Ventures and the Fundamentum Partnership. And last, but certainly not the least, our moderator for the day, Mr. Umesh Kudalkar, who is a director at Multi-Ag Trade and Investment Private Limited. Now, I request Mr. Umesh to kindly take over from here. Over to you, sir.
Yeah,
Thank you, everybody, and welcome everyone, the panelists, the faculty, the students of IIM Amritsar to this panel discussion on venture capital. My name is Umesh Kudalkar, and I manage a fintech fund for Multi-Act, and I am the moderator for this panel session today. At the outset, I must thank Mr. Chetan Chitre, who is my dear friend and a professor at IIM Amritsar, because of whom I have been on this. They have invited me to moderate this session, and it is indeed a pleasure for me to be with you on this Zoom call today. Now, as a first step towards being a moderator, I wish to understand what students were expecting out of this session. Hence, I requested for a sample of questions from students. And from some of these questions, I thought that the students were expecting VCs to fund greenfield projects in healthcare, such as hospitals and vaccine manufacturing plants. I would hasten to say that most VCs don't fund such greenfield manufacturing projects. Over the past decades, venture capitalists have been investing in computer science-enabled internet businesses rather than brick and mortar manufacturing plants. The reasons are obvious. This is an era of highly scalable, winner-takes-all, network effect-based platform business models. And brick and mortar businesses stand no chance when measured against the parameter of instant global scalability. We have an eminent panel here today, and I thank all the panelists for their time and being with us today. We will learn from the panelists about the evolution of the venture capital industry and what are the hot sectors for venture capitalists post the coronavirus pandemic. If any of you is looking to start businesses, I'm sure you would like to hear from the panelists about how they evaluate new businesses and startups and what their investment strategies are. Finally, I propose to ask them questions about jobs and careers in the venture capital industry. I will ask on an average about 4 to 6 questions to each panelist. I may or may not ask the same question to all the panelists. The idea is to ask a distinct set of questions to each panelist so that we have a wider perspective of the venture capital industry. Considering the mean time to answer the question as 2 minutes, with about 20 to 30 questions, I expect the session to close within 1 hour. This will be followed by questions from the audience. So without further ado, I just get on to my first question to Chinu. Chinu, can you tell us about the evolution of the venture capital private equity industry in India, and more particularly, difference between VC and PE, Silicon Valley model versus Mumbai-Bangalore model?
Excellent. Thank you, Umesh. And once again, I want to thank the IIM Interaction Cell, faculty and students for inviting me. It's a great pleasure to be part of this session. So coming to your question, Umesh, so I'll just take it a little 50 years back. If you look at private equity and venture capital, people often get confused. Is there any legal distinction? No. It is just evolved by people, how they differentiated the investment sizes, the types of investment actually. So if you look at in the United States, the venture capital activity predominantly happens in Silicon Valley, and the private equity happens predominantly in New York actually. So if you look at the nature of the investment, the private equity investments, the ticket size is large, more financial oriented. They take a big company and try to private. It could be in a public market. They take it in private and they do management buyout. But usually they run into a few hundred millions or billions actually. So coming back to the West Coast in Silicon Valley, it's predominantly tech driven. And so the idea is new. So you could be entering in a seed stage or post Series A, Series B like that. But it's relatively small ticket size, more tech driven. There is a lot of growth actually. So this is the biggest differences actually. The demarcation has happened in US private equity and venture industry. So let us shift and move to India. If you talk about 10 years back, there wasn't much of difference between private equity industry and VC industry in India. So if you look at 15 years back, the investments were predominantly private equity investments into port, infrastructure, or maybe energy like that. So about 10 years back, what happened? Actually, that more investments started happening in venture space, like companies like Flipkart, actually. So I think now the model is emerging such that if you look at Delhi, Mumbai, it is more private equity, and whereas Bangalore, it is more venture capital, which is tech driven actually. And even within VC fund, there are a lot of classifications are coming out. For example, you take our fund, Xfinity, we have been focused from day one into B2B, enterprise technology, which is capital efficient. So we thought there is a market for that. So like that, in the coming years, I do see more differentiation within the VC industry itself, and there will be more demarcation happening between private equity and venture capital actually.
Oh, thanks a lot, Chinu. I think that was an excellent overview. And just to add to that, the VC industry began in the year 1980s with ICICI Ventures and Gujarat Venture Fund and IFCI Ventures. And there were several state-sponsored funds, like, for example, Maharashtra had one, Rajasthan had one. And it has come a long way, and private funding is now the dominant form of the venture capital industry today. Now, with this background, let me move on to my next question for Sanjay. Okay. All of us are curious about how venture capitalists are responding to the environment post-coronavirus crisis. So I have two related questions for Sanjay. Number one, how are the investors dealing with the extended time investment horizon, both with the portfolio companies and with their limited partners? And number two, which industries will be the winners and losers in the post-pandemic world from an investor's point of view? Over to Sanjay.
Thanks, Umesh, and thanks IIM Students Committee for giving me an opportunity being on the panel. So Umesh, like a true venture capitalist, try to optimize his internal rate of return by merging two questions into one. Thanks for that. So, taking the first question is that how, we guys are dealing with the extended investment and exit horizons. So this is really a challenge. And, even in the pre-COVID era, exits have been a challenge, as, all of you, might follow, in terms of the exit timelines of, the Indian VCs. So what has happened now is that most of the Indian, VCs are closed-ended funds. There are not many open-ended funds in the country, and we come with a horizon of about 10 years life cycle. So already, I'm seeing, in my peer group and even with our funds, already there are talks of lifetime extensions. So already there is a lot of discussions with the LPs there. The second aspect is the exits are being pushed by at least 12 to 18 months, and there are certain LPs who are looking for liquidity. So what is going to happen post COVID, when things start settling down, we will see a lot of activities in the secondary market. Both, there are a lot of funds already existed in India who are interested in the secondary positions. In last 3 years, about $3 billion of secondary exits have happened in India. So it is going to see an increased activity when it comes to exits. And, in addition to that, there is going to be a lot of activities at the secondary exit level, at the LP level, where one LP, who is in need of liquidity, would sell to the other LP at a discount. So these are some of the trends, which are emerging at the, when it comes to the relationship between LP and GP. As far as portfolios are concerned, yes, again, right now the focus, and I would say in first 4 months, focus was more on survival than the strategy. So what we have seen with our portfolio, and I'm sure that it is true for most of the venture capital portfolios, so budgets and accountabilities, they were getting abandoned, and people were more on survival mode. As far as funding activities is concerned, there was more focus on funding the existing investments, and which is also seen in a 50% lower funding, which has happened in the first half of 2020. So most of us were channelizing are dry powder to the existing investments. It is changing now, and people are actually started looking at new investment avenues as well. The startups have basically have taken all the actions to extend the runway, right from pay cuts, by the senior management to leave without pay, and also, what we are also seeing, the change in the compensation structure where more and more variable component is being added, so that people are able to extend the runway. So these are some of the tricks which the portfolio companies are basically sort of playing to overcome the scenario. Now, coming to the second question, that what are the key sectors which will emerge winners? I guess I believe, and at our fund level, that the retail going digital is still a big opportunity. While pole positions have been taken by these two biggies, but what we are seeing is that there are a lot of horizontals, or rather, I'm sorry, a lot of verticals which are being emerging, in the consumer internet space. And in our portfolio, what we have seen is unprecedented growth in sectors like e-grocery. It first started, people were forced to, buy online. But now, even with ease restrictions, they have experienced the convenience of online shopping and the choices available. So there is a lot of traction on e-grocery. So at our fund level, we believe three E's are going to get benefited significantly. E-grocery, which right now is about a 2 billion market. We believe it's going to be, at about 18 billion in next 5 years. And there are a lot of verticals which are going to emerge, daily subscription models, like Milk Basket. Then you have meat delivery like Licious, and e-grocery. Already there's a lot of action happening, as you guys must be following. The second is edutech. It's being one of the underdogs and least expected sectors. There is a serious action there. Again, in next 2 years, this could be about a 3 billion market. And like e-commerce, there are a lot of verticals emerging, even within the edutech sector. And it has also got further impetus by the new education policy 2020, where government is emphasizing, delivering lessons beyond chalk and the talk. So there is, a lot of opportunities there as well. So I guess these three sectors will be the winners, post-COVID. And I'm sorry, third sector, I should have mentioned is e-pharma. Again, right now the pharma retail is about 20 billion, and the e-pharma penetration right now is as low as 3%. And the total market is about 500 million. We believe that people have experienced the convenience of, getting medicine delivered at home, and that, coupled with other aspects of the entire healthcare ecosystem, which is diagnostic and also the prescription, there is a very interesting healthcare ecosystem emerging in the country. And within the e-pharma space itself, we believe that in the next 5 years, from about 500 million, this could be a 3 billion market. So we are very, bullish on e-pharma as a space.
Okay. Thanks, Sanjay. That was extremely insightful. As I see the move towards paperless and virtual, it is throwing up many opportunities, as you said, in the education. But I also see opportunities coming up in the financial services space. The virtual delivery of this particular panel discussion itself is a good example. Video KYC is becoming a norm for most of the financial products. And even in real estate, transaction workflows are moving from pre-sales using drone footage to legal agreements using DocuSign and virtual registration. Thanks for sharing your thoughts, Sanjay. Let us move on to the next aspect of venture financing. And I want to ask this question to Ninad, who has deep insights into early stage financing. And here is the question. So Ninad, what are some of the key trends that remain relatively constant in the early stage funding cycle?
Thank you. Thank you, Umesh. Thank you for that simple question, but a loaded one.
Sanjay was lucky. You asked him 2 questions, but they were not so loaded. It's a short, sweet question. We're loaded with. But thank you for this question. Thank you. I am Amritsar student, faculty, and director for inviting me to be part of this panel. What are the key trends which are common? So simple question, but a lot of. I'll try and encapsulate my thoughts within the next 2 minutes. Trend number one: startup founders want to make tons of money. That trend has not changed. It's a journey of wealth, not a journey of income. They realize that, and that mindset is not still remain. In COVID there was a pause button for overall in the industry, but now there's no pause. It's almost it's coming with a vengeance. So trend number one, tons of money. Trend number two, tons of ideas. You talk about anything and everything, there are ideas galore. Just to give Umesh, and this is not a commercial for 100x, where I'm a partner, we got 4,000 applications. We went through 800 pitch decks, finally invested in 9. So see the funnel. So see the number of ideas which came to us. And this was for class 2 where we invested in 9 companies. Class 1 where we invested in 20, we got some 2,000 applications. So there's no shortage of ideas. So number one, tons of money startup founders want to make, tons of ideas. Third and more interesting trend is everything is now, of course, people used to talk constantly, everything is technology. Coding is the new English. If one of the founders is not, co-founders is not with a tech background, the startup finds it difficult to pivot, to figure new models. So technology's importance, not just from a broad perspective of strategy and all, really, really narrow perspective also, is become very, very critical. And fourth now, particularly post-COVID, the trend is of evergreen business. No one could have predicted COVID, and hopefully we'll never see it again in our entire lifetime. But more or less a business model which is evergreen. Now, what are the trends from investors like us, early stage? Again, we want to make a lot of money. But yes, we like to nurture ideas. We like to give them shape. And we hope to see them getting the next round of funding. So these are the broad trends which were there pre-COVID, post-COVID, and they will always remain. Broadly speaking, there's a lot of optimism on both sides of the table. There are a lot of ideas, and there's no shortage of funding. Capital is chasing ideas, as simple as that image. Capital is chasing ideas. And it's not the other way around. Of course, if you're a startup founder, you might feel the other way around. It takes time to raise money, but capital is chasing good ideas. So these are the broad trends. Umesh, thank you.
Thanks, Ninad. Particularly your observation about the funnel from 1,000 ideas right up to 9. So that's the ratio that one would expect. And also one unusual observation about your coding, the third observation. Thanks for sharing your insights, particularly a couple of them were quite unusual. As you observed, these trends are relatively stable. Now, I will move on to my next question for Amitabh. And having seen the evolution of venture capital now towards private sources of capital, now let us look at the distinction. Let us look at the distribution of venture capital, domestic versus foreign sources of funding. And here is my question for Amitabh. Okay? There isn't enough appetite amongst domestic LPs and ultra-high net worth individuals for investing in venture funds. In view of this, is the future of India likely to be controlled by foreigners like as in the British era in the 18th century?
All right. So to start with, I'm Amritsar. Thank you for having me here. Umesh, you've given me 2 minutes to answer a question that I could answer for hours, but I'll try and keep it short. Appetite. Appetite is a cultural function, right? In this nation, we're not risk takers. We've never been conquerors. We just don't do everything. That appetite will develop over a period of time. The first rush of venture capital, you said it in the 80s when the government tried to do some funding. late 90s when more private capital came in. When UHNIs in India actually woke up to the fact that higher risks, higher rewards are a possibility. Let's face it, for a majority of us, we're still uh, stuck in the mutual fund and SIP cycles inside our heads. That said, you know, money has no religion, money has no reason. Money has only reason, and its reason is to grow. When you talk of India, I honestly and sincerely believe that we're talking at the most fruitful uh, crucible in the world today as far as the possibilities of making money grow are concerned. When money travels to these shows, money is coming here to make money. They're not coming here to tell us how to grow. If they knew that, they'd do it domestically. Will they control our future, or are we likely to end up controlling other people's futures because we have a stronger hold on what their money will be able to do and how their money will be able to perform? Is a question we should ask ourselves constantly. And I think the dice are loaded in our favor. And let the money come. I think no economy in the world has ever benefited from saying, I don't want your money or your money. If it's clean money, by all means. I don't care if it comes from China. And China is persona non grata right now. They're on the public enemy number one list. I'd rather take my enemy's money and have him beholden to me. Ultimately, if I make it grow, I'm in a position of power. So I think that balance of power is something we need to consider. I don't think we're in any danger of having our sovereignty taken away from us because people are investing in us. So long as we are growing that money, there is no one, except perhaps sovereign governments if they start putting money into us, who will try and dictate policy. Funding dictates policy when they feel the founder isn't going fast enough. I don't think that's likely to happen to us anytime soon. Couple of things that we do need to do. We've never been product people, which is one of our greatest shortcomings. In India, we're not risk takers, right? We're risk averse. We deal in 10% rather than 5x, 10x, 100x. Uh, you see me not smile when I say 100x because that's their perspective. Won't happen unless we start taking funds, unless we start talking products. But if we manage to do that successfully, there is no reason why we should be in any danger of being cowed by anyone at all ever. And you're seeing it, with money coming in from all corners of the world, people are competing. Japanese capital today competes with Chinese capital and American capital to try and find its way into India on favorable terms. If we do not provide favorable terms for a while, they will come on our terms as well. We're on a path where only we can knock ourselves off. We're doing a pretty good job of trying to follow off that path right now. But I think we're set for a fairly decent time, provided we stay hard focused on creating value and creating wealth.
Thanks, Amitabh. That was, I mean, money has no religion is the key takeaway, as I see from your reply. Um, I would like to add that there is a contrary path taken by China, which domestically funded startups and banned internet MNCs. Now it has got Baidu against Google, Alibaba against Amazon, and WeChat against WhatsApp. And I can give several other examples too. We will have, I don't know which is the correct path to follow, but we should be mindful and also study the alternative policies followed by one of our biggest neighbors. So, having commented
So I'm just
this,
going to say one thing on that, Umesh, is that you can be king of a silo, but you're still inside a silo.
yeah, I agree. I agree. So there are
The
pros and
world's
cons on both
largest,
sides.
the world's largest credit card company a few years ago was UnionPay.
Yeah.
They were strictly limited to China. They're out there in the world competing today. Where are they?
Yeah, I agree. So it is
Mastercard,
all
Visa, both bigger.
it is all pros and cons of, yeah. So I wish to come back to the macro now and the coronavirus crisis with a question to Mitesh. Okay. The question is, after the WeWork fiasco amid the coronavirus crisis, how do you see the funding market shaping up?
Thanks, Umesh. I'll take 5 quick seconds, first of all, to say that thanks for having me here. It's absolutely an humbling experience to address all you intelligent students at IIM, which in my student career, I could never dream of making it to. So it's something where, I'm getting a chance to address to IIM students. That itself is a bit nervous making experience as well. Coming back to your question, Umesh, very interesting trends emerging. I think around March, when the COVID crisis happened, and the WeWork crisis also happened, there was a lot of nervousness. Investors were holding on to money. First of all, this was a crisis which nobody could have anticipated. This just came out of nowhere for the entire world and hit us very, very hard. It took a lot of time for people to realize what's happening. First of all, what's the depth of this crisis? How long this will last? April onwards, I think things started changing a bit. We saw, momentum swinging in favor of people actually coming back or trying to come back to business. And some founders like stood apart. People actually framed good business ideas around this. There was some headwinds, tailwind, where sectors like edutech, sectors like health tech, gaming, content, these kind of flourished. They actually made an opportunity out of this, right? And some other sectors like travel and hospitality, they were bound to kind of, be bogged down for a period of time. But to answer your question, Umesh, in short, funding actually was never a problem, barring that 1 month from, or 1.5 months from 15th or 16th of March, when probably all of us started sitting at home and working from home, and post that Janta curfew. Till third week of April and all, I think this people are trying to figure out that what's best for them and should they preserve cash or deploy. After that, there has been a lot of demand for good startups and good funding opportunities. So funding has never been a problem for the businesses who deserve them. And that's what brings to me to the point that I want to make here, Umesh, is that for the students who are there on this call, never chase funding. Chase, making a good sustainable business model. Funding will follow by itself. There is enough capital, and I can speak on behalf of everybody on this panel. I take the liberty of doing so. There is enough capital flowing in the market if you guys create a great business model, which is not a Me Too model and which is not created to take money for the investors or something that the investors would like. Decide what's the problem to be solved, decide which is the best way to solve it, decide where unit economics will work and go for it. Great founders, great businesses, great valuation. That's all we need. So funding, Umesh, has never been a problem at all level, be it, an angel investment platform like us. In last 6 months, we at IPV have done about 20 deals, right? And I have the privilege of being on both sides of the table when I wear the head of a CFO at Book My Show and wear the head of an investor as co-founder of IPV. I'm seeing, there is great trend emerging all around. Private market, there is enough money flowing in. Public markets are almost at all-time high, and things are really, really, rapidly coming back to pre-COVID level. Maybe there is nothing like post-COVID. Maybe this will be with COVID world that we'll all have to live in, and that's what some guys have adapted to beautifully by developing a sustainable business model. And for them, funding has never been a challenge. So that would be my answer to this, Umesh.
Okay. Thanks a lot, Mitesh. I think I liked your key takeaway, which is like, I remember that Field of Dreams movie, wherein, the tagline is, you build and they will come. Okay. So essentially, you build a sustainable business model and the funding will come. Okay. That's the message I think you want to give. It will be interesting to watch the performance and actions of mega funds also, like SoftBank going forward, how, things shape up for them and, the other large players. Now, let us move on to the next second round of questions, starting with Chinnu. And this particular question is common to each panelist, and each panelist is requested to dwell on one evaluation parameter. This question is about deal evaluation. Okay. So what are some qualitative factors around a startup that a VC looks to evaluate? Okay. So how do you evaluate a deal for, say, founding team evaluation of revenue model, sustainable competitive advantage, large addressable market size, global scalability, and the growth potential of a startup. So I would request each of the panelists to pick up one parameter and then dwell at length on that. Okay. For example, if Chinnu chooses to speak about evaluation of founding team, then the other panelists may choose to speak about other parameters such as say revenue model or sustainable competitive advantage. So over to Chinnu.
Great, thanks, Umesh. I'll take the first one, the founding team, which I am passionate about it actually. And I can talk about others also, but this is very interesting topic actually for me and very close to me. Just to give a little bit of landscape. See, if you look at in our father's generation, 40, 50 years, getting a government job was their probably their biggest dream. In our generation, probably either you work for an MNC company or do MBA or go abroad. That was probably 20, 30 years back. But I think today I found, because I'm saying this because I met about 400, 500 entrepreneur companies in the last 4-5 years. I think it is culturally accepted. You're a star if you're a startup founder actually. You don't get that kind of attention notice in newspapers. Perhaps if you're a startup founder, you get so much attention actually, which is a good thing in society. So anyway, so I think, coming back to how do I look at the founding team? I can go on hours and hours, but I think I'll take few things and I'll kind of elaborate on that. So first thing, I look at the passion in the team. Passion in what they do, whatever they like to do actually. It could be, they may be good in certain things. They are very hands-on with certain things, or they have creative ideas. It could be new technology idea. They go well beyond what has been asked. It could be in the previous company, or it could be in academic setting. Just to give an example, some of the couple of founders. So there is a company we founded called Absentia. 3 dropouts from BITS Pilani. All of them dropped out and they started the company in video gaming that got pivoted, but none of them had experience. But when I talked to them first time 3 years back, I could see the fire in them, and they knew about a lot about that sector more than somebody who works in industry. Or another example I would give, we invested in a company called CloudSec. The founder of the company is a college dropout. He's an ethical hacker. He was invited into global forums for the 7-8 years into 80 countries actually. So you have to be passionate about what you do. That is very, very important actually. You should really like it, because not everyone, every entrepreneur becomes like Baiju, like you get flashed in newspapers and everything. You should like, no matter what the outcome, you should be really liking what you do. That's very, very important. The second thing is perseverance and strong will. One thing I found with all the successful entrepreneurs, when I say successful, it's not necessarily they're financially successful. Many times the companies go south. I don't consider that to be a failure, because they come back and again they start another company. When I say successful entrepreneur, they would have created something. For market reasons, it may not have taken off, but they have perseverance. Even ups and downs, they really sail through the company. That is very, very important. I have seen the common trait in a successful entrepreneur is they stick together in ups and downs, because you're talking about 3-4 years. When you develop a product, the market changes, the product, you encounter so many problems. So we look for traits like, are they into sports? Because usually that's an indicator how strong will they are actually. Are they into some activity, marathon running, or some kind of sports, or something passionately they pursue for years and years actually. Third thing I look at is the complementary skill set. So sometimes we back companies with single founders, but we like to have 2-3 founders who complement each other. So one thing we ask them, are they friends in college? Okay, fine. But have they worked together? Because when you work together, many issues come. How do they sort it out? If they have worked in a company 4-5 years, that makes a lot of difference. So we look for complementary skill set. Even within the founder team, one could be a leader. The other could be somebody who is not visible, but could be very good in technical. The other one may like operation. The other one may like marketing. So we like for a good complementary skill set actually. And how do they articulate? It's very, very important actually. I think, one common thing which I see lacking in Indian ecosystem, but it is improving a lot in the last 4-5 years. How do they commercialized ideas. That is very, very important actually. So there are many things we look at it. And I can also add, like, out of the 23 companies we have invested, 4 companies are founded by women entrepreneurs actually. And we also give importance to that actually, because we have found companies founded by women entrepreneurs, at least one woman entrepreneur, they have a lot of success actually. So we look for many traits like this actually. So I think, like I said, that I can go and talk more things actually, but I think for lack of time, I'm limiting to this, and I can talk in the post session also.
Thanks a lot, Chinnu. That was really an excellent reply. So over to Sanjay. What would you like to pick up? Revenue model, sustainable advantage?
So I guess I'll pick up from where Chinu was left. Once Chinu has cleared the founders, I guess the next most important thing for us is the market. And what I said, there's going to be a lot of bias because we do basically consumer internet. So a lot of what I say will probably be biased by our own investment thesis. So for us, when we are evaluating an idea, market has to be very large. We believe that, and we have some of the numbers as starting points, that if you're evaluating a particular segment, what is the market size? Is it attractive enough? When we evaluate a market, the second thing is the market growing? Because what we've realized that initially, when it's a pre-series A, Series B company, on a smaller base, they've been able to post significant amount of growth rates. But then somewhere in their life cycle, they become stagnated, and this is where all the trouble begins. So market has to be growing. And third, and again a very important point is, apart from a large market, what is the profit pool, right? Because most of us get influenced by very large market, but at the end of the day, the startup, when they're pitching an idea, if the profit pool is not enough, that's a problem. Not to be negative about a sector, but just to give one example, let's say agri-tech. There is a lot of action in the agri-tech, but when you actually go deeper, evaluating an agri-tech startup, you realize that probably it is the largest market in the country. But having said that, when you come to the profit pool, there are a lot of questions. So profit pool is the third one. The fourth one, I would say, is barriers to entry. So when we are evaluating a startup, is their business model, easy to copy, right? Are they solving any unique market problem, or they are like middle of the run? Giving an example of a couple of startups, there is this company called Licious, which is a meat delivery startup, right? Again, a large market, and they solved a problem from unorganized to organized. It was a totally unorganized sector, and they made it a beautifully organized sector by the use of tech. So what is the play which is to be had, which will generate a long-term value? That is something which we bring into our market assessment.
Yeah. Thanks, Sanjay. I think your concept of profit pool was quite enlightening. I mean, addressable market size may be large, but if the profit pool is kind of very small, then it doesn't make sense to invest. Over to Ninad, your views about any of these parameters?
Thanks, Umesh. I'm glad I'm third and not the last. I would have been left with no options. So I pity Amitabh over is last. Mitesh, of course, can handle all of the above. You can speak on anything. But I will speak on, since these two are covered, I'll speak about competitive advantage. And this is one area we deal in early stage startups. At that point, it's really not proven. An idea, is there a competitive advantage? But that has to be articulated extremely well. Let's assume, just for namesake, Rajat, since I see his name right below mine, Rajat comes to me with an idea, and this is how he'll tell me, and this is how he should say. So first he'll tell me, I want to change the world. This is the best idea in the world. It's going to be radical. It's going to do. So they're so passionate, and rightly so. Rajat, I'm sure if he does a startup, will be so passionate, rightly so. But it doesn't give any flavor of competition. In probably 6 out of 10 pitch decks we see, there is no strong mention of competition, because rightly Rajat feels, my idea is the best, my startup will be the best. What are you talking about competition? But it doesn't move the, that's not the way how you'll get funded. That's not how you assess or evaluate a startup. So competition, competitive advantage is very, very critical. What is the moat you have in your business, Rajat? What is the unfair advantage you have in your business, Rajat? Do you have an IP, Rajat? Are you first in this? No, if you're not the first, no problem. If you're the second, also there is no problem. What is it that you're doing better than the competition? Is it a cost advantage, technology advantage, process, something different? Very critical. Most of the times, Umesh, founders will come with a quadrant, and obviously their startup is in the best quadrant possible without a feature by feature comparison. Everything needs to be articulated. Your moat, your unfair advantage, what is it you're doing better, all of it has to be clearly articulated.
Yeah, thanks, Ninad. I think that is an excellent overview. I have nothing to add. I will request now Amitabh to pick up any parameter and dwell on it.
Sure. So, this one's really interesting, and I think
Amitabh, there is a lot of noise coming in. I don't know why.
from here, uh, is it any better? I don't know.
Yeah, go ahead.
So, I'm saying this is interesting because each of the answers comes from a lens which is at a different stage of the investing cycles. Where I normally engage with founders, um, there are very few certainties, and there is absolutely no performance to look at. What I would typically look at, especially because I happen to mentor a lot of companies, this is a different sort of engagement, um, is that when you've got nothing that you can look at the past on, what do you assess? I normally ask people, do you have a template for success? If you do, I'm sorry, I can't work with you. Because entrepreneurship is like being sent out blindfolded into a place where you've never been before. If you think you've got a map, you're going to get lost. So the first thing I look for is, if you live in a world of certainties, entrepreneurship is not your cup of tea. If you cannot exist without a certain high element of uncertainty, welcome to our world. This is where you should be. Second thing for me is the logic of your business. Now, people who do what I do, we don't have the luxury of being sector specific. People come to us from all kinds of businesses. I myself have built 8 businesses till date. No two have been in the same space. Agnosticism is something that has served me well because it allows me to get to the root of what somebody is doing. Is there a certain logic to your business that you have arrived at? X needs Y. Or is it that because Mr. Sachin Bansal launched a company, I will launch a slightly smaller one? If the business doesn't have a logic that will sustain it, Ninad has some fabulous questions. People will say, I have no competition. Boss, if your market is so immaterial, also insignificant, that on a planet of 7 billion people, nobody else is looking at it, shut it down. You're in the wrong business. So have competition, please know what they are, and as he said, can you differentiate? Um, I like to ask founders, have you ever played football? Everybody has, right? And in football, it's also conceptually, it's an easy game. You've got a team, you've got an opposing team, you've got a ball, lines, goals, linesmen, rules. What if I were to take away everybody on your team, everybody on the opposing team, all the lines, all the officials, all the goals, and all the rules? I gave you a ball and said, now play football. Can you? Can you make it up as you go along? Can you examine at every step what did you do? And do you have the courage to knock that ball backwards as well, if required? So I look for that flexibility. I also look for coachability. If you are already the finished product, your company has zero chances of survival. All of these are fairly esoteric. Everything else can be taught. You can learn your market. I don't care if you've never operated in that market for even one day. I have entered markets myself, which I have never operated in. I'm willing to get my knees skinned, my knuckles bloody, learning that. But do you have that? Are you willing to go out there and figure out how something works rather than opening up a textbook? If you don't have the spirit of adventure, I ask people, what do you read? People who tell me that they read only management books, I'm sorry, you don't have an imagination. People who tell me I read fantasy, I say, all right, let's sit down, let's have a cup of coffee, let's talk. Are you challenging the world as it has been taught? Are you looking at what is beyond the bend? Are you imagining what could be? If you're doing none of these, you're building a legacy business. Do it.
So Amitabh, what you're saying, the audacity to design a new game is something that you look for.
Absolutely. If your game has somebody else's rules, you've lost.
Yeah. So thanks for this. I would like to move now to Mitesh and request him for his comments on the parameters for evaluation. Over to Mitesh.
I'm audible?
Yeah.
Sorry. I'm going last. So most of the points have been taken by predecessors, but I'm glad one very important point that is still left for me is valuation. In fact, I'll make 3 points very quickly in the interest of time. So valuation, obviously, businesses are great at a certain value and businesses again are bad at a certain value, right? Every business, while inherently it will be good or bad, but at a certain value, obviously the perception about that business can change slightly, if not entirely. So I think it's very, very important for founders to understand that whatever they think of their business very, very highly in terms of valuation, always leave something on the table for the investors. Make sure that you are getting right investors in your cap table who can help you with smart capital, not dumb capital, and they work with you to grow the business. Don't worry about valuation too much. Don't worry about dilution too much. Market forces will take care of that, and you'll get your due valuation in due course. Second thing, which is a subset of founders, as Chinu said earlier, is execution. With due respect to all the founders or wannabe founders on this call, founders by nature are very smart in projecting a story. Founders nowadays understand what a VC looks into, right, in terms of narrating a great story, and they come up with good story. But is a story enough? Answer is no, right? I need great execution. Ideas are a dime a dozen. It's all about execution, execution, execution. Unless you have a proper second line of executives, a proper execution plan, a proper operation plan, no amount of smartness in the founding team or capital will be enough to win you the battle. Third, finally, which is something which is very, very personal. I'm sure again the panelists will agree, is something called instinct. Some of my good investments have been done with that instinct that, you look at the deck, you look at the founder, though it will not tick all the boxes, but something within you tells you that, okay, I think this is something that is a risk worth taking, and those kind of pay off. So these are the three things which I will look for when I invest into a particular story.
Thanks, Mitesh. I think you were the last one, but you picked up very extremely valuable points, which is valuation and execution. Extremely pertinent and really very high value added on those points. So I thank you for the same. I would like to add one thing, and which is VCs look to fund a product that is 10x better than the existing alternative. And the product must eliminate the existing friction and address the pain point. Okay? And for more about this 10x phenomena, I would request the students to read Peter Thiel's book, 0 to 1, that has an excellent explanation of this 10x concept. Now, moving on to the next question. which is, let us touch upon corporate venture capital. So here is my next question to Chinu. The question is, how corporate venture capital is shaping globally and in India, and how the VC investment ecosystem is being shaped by corporate VC as against the financial or the tech VCs.
Great, thanks, Somesh. And for students who are listening to this, probably you may be hearing about corporate venture fund. It was not there. It was not so prevalent like 10, 15 years back. Like if you look at 20 years back, my alma mater, Intel Corporation, they had set up probably the first corporate venture fund actually. So what is the difference between corporate venture fund and regular VC fund? I'll come to that a little later, but it is becoming an integral part of startup ecosystem. So about 20, 25 years back in Silicon Valley, like big companies like Intel, Cisco, they realized many of their employees are leaving and starting their own companies actually. So they felt the talent is leaving out. How do you retain them? So what they have done, they have set up a fund called Cisco Capital, Intel Capital, like that. Okay. So they have given the similar opportunity or similar ecosystem like a startup. They'll give you the capital, you go and pitch, and you get the funding based on milestone. They will keep increasing it actually. So that way, the employees who are entrepreneurial, they were kept in the company actually. That evolved furthermore. Then the companies started to realize that they can actually use this to fund companies which are strategically aligned. So what has happened in the last 15, 20 years, every company, major Fortune 500 company you can think about, even the so-called non-technical companies, like Shell Ventures has a capital, like Boeing has a Boeing capital actually. So what they do is they have a fund which is $100 million, $200 million, or $500 million. They go and invest with private VCs like us if it is strategically aligned to their business ideas actually. So for them, what is happening globally, the corporate companies, they realize instead of putting more money into R&D, which used to be the way 20 years back, they realized this is the best way to go and put some money. So you put money into startups which are coming up, and if it is aligning to your interests, actually, you kind of watch them. At once it grows to a certain level, they even acquire them actually. So I think it is very important. You also keep an eye if you're starting a company, you get private capital from VCs like us. Also, you keep an eye on the corporate venture capital, which may be aligned to your interests actually. So the moment, see, the way I look at it is when you're building a company, you should be looking backwards from exit actually. So let us say if you're building a company 4 or 5 years down the road, either you go for IPO or you're going for an exit actually. If you're thinking about exit, you should know which company you're likely to sell, maybe 4 or 5 companies actually. Then you work backwards. Why would they be interested, right? What is their competitive roadmap? What is missing in the roadmap? Then if you go and tell them along with the private VC, they are likely to invest. Even if they invest, they bring a lot, even if they invest smaller amount, they bring a lot of benefits. They open their businesses for you. They are ready-made GTM partners because in startup, GTM partner is very, very important. So you get a ready-made GTM partner. Then you have a potential exit opportunity also, right? And if you look at for students, they also nowadays corporate venture funds, they run so many hackathon events, team-based startup events. You get prizes, some of them maybe even 50K, 100K US dollars actually. So it is very important, I think, if you're planning to start a company or if you're planning to do it later, or even if you're working for a big company, please realize there is a corporate venture fund. If you're an entrepreneurial mindset person, you can go into the corporate venture fund. You can start a company within a company. It is available actually. So and it is becoming an integral part of the startup ecosystem because they fund during the startup growth. There are many exit opportunities through the corporate venture funds and GTM partnerships.
So thanks a lot, Chinu, and I must profusely thank you for this answer because you touched upon the exit, imperative, okay, and how we should be thinking about exit first and then work out backwards, okay.
Correct.
And because you covered this, it was really a bonus because I could save one question and somewhere else, okay. So thanks a lot for this. We have funded one insurance analytics company that is located now in Hartford, Connecticut. And they have a US office there. And the reason that they have located there is because most of the corporate venture arms of insurance companies like AIG, etc., they are located in the Hartford area.
Correct.
So what we are looking for, the Series B round, we expect them to find that process easier as they begin their roadshows. So now that I'm talking about the Series B round, let me ask my next question to Sanjay, because he does Series B rounds. So the question is, what does a scale-up VC fund like Fundamentum, which participates only in Series B, look in a startup before investing? Over to Sanjay.
Thanks, Umesh. So I'll just keep it brief because a lot of it is already been covered when, in your previous question, how to evaluate a startup. So I guess, when we set up, this fund called Fundamentum, we were very clear that, in terms of our own experiential learning with Helion, which was India's, one of the oldest VCs, and we were doing pre-Series A, Series A predominantly. We realized that, maybe, if we come at Series B and C, probably we might not be able to get 50x and 100x's, which is like synonymous with the VC return. But we realized that, after analyzing our portfolio, that, in terms of risk and reward, our returns Series B onwards have been significantly higher. So just to give people a bit of a sort of flavor that why we went to Series B, because it was more of what we experienced with Helion. Now the basic fundamentals are quite similar to what a Series B investor will do. So our basically secret sauce is that we in our investment committee we call it 4 M's, and like Chinu spoke about management. So the first M is management, and I will not repeat what Chinu said in great detail, but I will use some buzzwords when we evaluate the management team. That's the first the evaluation criteria for us. We in the management we look for a couple of characteristics. One, it has to be, they should have a delayed gratification, in terms of, when you evaluate their personalities. What we believe that, if you're coming at Series B and Series C, we believe in institutional building, and we want to be convinced that founder is in it for a longer haul, and will not face things like liquidity baskets and liquidity opportunities, etc. So delayed gratification is something which is very important for us. The other the characteristic we look at is the tech DNA, because we believe that the way India is kind of shaping up on the world digital map, lot of values to be created by tech investing. So founder without a tech DNA is a no-no for us. Third thing is coachability. These are all smart guys, from great educational background, but still we believe that most of them do not have big corporate experience. So how will they, cope up, when they're, let's say they become a unicorn or they're a unicorn, are they coachable enough? So that is the third, ingredient we look when we sort of evaluate the management team. Now I'll move to the second M, which is the market. I touched upon it. We prefer full stack model. We realize that a lot of value is to be created if there is backward integration, given the competition. Repeatability, the hurdle has to be higher, for a competitor to copy the business model. I spoke about profit pool. The fourth important thing which we look in the market segment is the repeatability. So if it's a subscription-based model with a repeat behavior, that is certainly a plus with us. So we started with management, then we moved to market. Third is momentum for us, because we have already overcome that hurdle where our pre-Series A and Series A friends have taken all the risk of product monetization, because by the time we come in, product market fit is already there, monetization is already there. So for us, momentum becomes very important. So when I say momentum, what I mean by that is that whether the growth rate is better than the peer. In terms of, we have coined our own term called B2B, where B2B is, burn to break even, right? How are they dealing in terms of capital efficiency when they're compared with their peers? That becomes very important for us. So we evaluate them on, momentum. And third is that, path to profitability, right? Given the scenario right now, it is important that, sustainable business models are created. So therefore, capital efficiency has become more important, than it used to be earlier. And the last, fourth segment of this quadrant is multiple. And Mitesh touched upon the valuation. And this is where it becomes a very tricky game for us because, when you enter even at series B and C, the multiples you are being asked because the business model is being proven is being very different from what you get, when you exit either by way of an IPO route or by way of a strategic exit. So multiple is again very, very important for us, in terms of whether the model is IPOable. There are a lot of restrictions, doing an IPO in India. And also, in terms of the multiple, what you're paying right now and what you're likely to get based on your concept, both India as well as global. We dwell a lot on this fourth segment of multiple.
Yeah, thanks for an excellent overview. Now we are running out of time, but I think I will take the liberty of going through the last round of questions. Those are particularly based on jobs, careers, and entrepreneurship. So here is my first question to Chinu. What kind of knowledge and skills can students cultivate to become suitable to be hired for venture capital private equity funds?
So thanks, Umesh. Actually, it kind of overlaps with the founding team, which I had described a little earlier. Yeah. I think there are two streams of opportunities are coming for students, actually. One, you can go and start a company. That's a big step. There are students who do that. I have seen them being successful. I'll come to that a little later, actually, the qualification required. The second one, you can go and you can join a startup company. There are so many startup companies that are opening up. The preference from student communities to join a startup community, startup. The third one, you can always join as an analyst in a fund, VC fund like us, or corporate venture fund, what I talked about it actually. So these are the 4 or 5 streams, students can probably go and join actually. Coming to this joining as a startup, if you're planning to join as a startup company, I think what they look for is they know that probably whatever you studied may or may not be too relevant to what they are working. But if you are looking at enterprise technology company, what we have been looking at it actually, we look at subject matter experts actually. We do look at certain PhDs. In many of our companies, we have PhDs right out of colleges actually, or MBA with finance skills. So definitely whatever you studied is very relevant. But more than anything else, let us say a particular startup company is looking to hire students. Again, they look for passion in the area what you can contribute immediately actually, because a lot of things you can learn on the fly because the technology is changing, everything is changing. Whatever you study within 5 years is going to become obsolete. That's the way it is looking today. So what they look for is, are you really interested in learning new stuff? Are you interested in going not upset? See, if you're a student, probably your responsibility is not going to be very high. But are you going to enjoy this actually? Because your pay may not be that great compared to a big MNC actually. But are you going to enjoy this experience actually? Do you have that mindset? These are the main things they look at it actually. Well, if you're starting a company as a student, probably you should think about your first year, second year like that. Like I said, many of our entrepreneurs who have come right after the college, they have become very successful. But only thing is they have been thinking, not necessarily thinking of a startup, but they are interested in that particular area for last 5-6 years. So you have to have that bent of mind actually. So coming to the venture capital, if you really like linking technology, business to the commercial value, being an analyst is a great role. I think many of you are MBA students, and we do hire people with engineering and MBA students. And if you want panoramic view, you want to look at multiple sectors, joining a venture capital for a couple of years is a great thing to do actually. yeah, these are the things I would suggest to students.
Yeah, thanks, Chinu, for your guidance. I think students will really appreciate this. Coming to Sanjay, I just want to ask you one question. How did you get associated with venture capital in your career? Was it by design or by accident?
Yeah, that's a tricky one, Umesh. Thank you for giving it to me. Yeah, so Umesh, if I go back to my career, and I'm an old guy, with 20 plus years of experience. So when when I qualified, this industry was VC industry is in a very nascent stage. And just on a lighter note, so in fact, when we qualified, I guess the point of arrival was to land a job with these Fortune 500 companies. And my career also started in a very traditional way when I started with Pepsi. Then somewhere along the line, I got an interview call from one of the large, VC funds. And just to share with you, I went for an interview, and it was in a very plush bungalow in a South Delhi, plush locality. And having come from Pepsi and G kind of backgrounds, when I entered the office, there were 4 people sitting in a plush bungalow. And I was like, what is this industry? 4 people sitting in a bungalow, what are they doing, right? So from that stage, I guess the VC industry has evolved big time. So for me, after I spent about a decade with these Fortune companies, I was like slightly bored because you have to play within the rules of the game. So this startup happened to me, this capital market startup called Amba, which was started by 4 investment bankers. So I, ended up taking that risk and joining that unknown company. And this is where, my entire thought process changed. And, if I have to pick up, what is the best job, which I liked in my 20 years of career is my startup stint of 7 years, where on the second day of my joining, the founder told me that, we don't have money to pay bonuses of our analyst.
Oh.
So, getting into that kind of a scenario, and when we sold the company to Moody's, we were the industry leaders, in terms of our operating margins, and this whole, excitement of building the company for 7 years, and then seeing that, monetization of your stock options, which otherwise, most of the time is a piece of paper, right? And that is my first stint with the, I would say first experience with the VCs, because we had 2 VCs who participated, in our funding rounds. So after having a Fortune 500 and a startup stint, I was figuring out, and I was fired when Moody's acquired the company. CFOs are the first ones who get fired, but I get no regrets because my ESOPs were encashed. So coming back to the point, I was just contemplating that, having seen Fortune 500 and a startup, what is the next logical evolution? That is the time when, I was very keen on joining a VC, and Chino covered some of the points, the thrill of evaluating various business models every day, being in touch with what is happening on the technology space, and more importantly, working with youngsters like you, bright minds, full of energy, full of ideas. So for me, the short answer is it happened partially by plan and partially by accident.
Oh, okay. Thank you so much for sharing your life's experience. I think students would have certainly found it extremely useful. Now, with this questioning round, I will turn over the questions to the audience, and so let them take it over. The coordinator, Rahul and team.
Yes, sir. I'll take over from here. So firstly, sir, I want to take this opportunity to extend a heartfelt thanks to our dignitaries for making this session truly knowledgeable for our students with their valuable insights. Thank you for providing us a view of what goes behind the venture capital curtain. We understood that founders and their team are very important, and that their ideas are important, and also how the competition and execution, etc., are looked up in venture capital world. I personally, and I believe It's the same for the students as well, who are able to relate to the application of various models we study, like Brio and SoftSWOT and whatnot. Now, with this, at this note, I would like to open the question floor for the questions, and I request Sauradip Chatterjee of MBA 06 to ask his question.
Hello, everyone. It was a very insightful panel discussion we had. I learned a lot. So my question is to Umesh sir. It is that what regulatory challenges do VCs are facing in India, and what are the changes in policy that might be required to support a robust VC ecosystem in our country?
Yeah, I think one of the challenges that we were facing is Section 56 of the Income Tax Act, okay, 56(12)(b) or whatever, okay, I don't remember the subpart 56, but what it said was if any startup is funded, okay, then the income tax authorities could actually treat the premium paid as profit for the startup, and they would tax it, okay. So that was to plug the loophole of possibly giving bribes into private limited companies, which are essentially shell companies. However, the medicine administered through that section was worse than the disease. Okay, but now they have addressed it, saying that SEBI registered venture funds are a startup which is registered with the government of India. Okay, the income tax authorities don't really haul you up on this particular regulation. So that was one aspect of this thing. Then another thing is when you're trying to fund a startup overseas. Okay, for example, you're trying to fund a Singapore company. Then right now there is a limit of $750,000 for a domestic fund to take approval from SEBI. The moment you hit that cap, okay, then you have to go back to SEBI, and SEBI in all probability would not approve. So you have to wait for one more year before that cap gets released. It's like the H-1B quota. So that's another limitation that I have found. And obviously there are certain others which other panelists may like to highlight.
I think you pretty much summed it up well. Couple of others, on an overall basis is Indian unlisted company not allowed to list abroad before getting listed in India. This has been perennially a topic of debate and litigation. Finally, I believe there are some green shoots there, probably some positive news about to be announced there. But I believe a lot of the early stage tech companies, even if they mature, I think they should be allowed to have the liberty of choosing the exchange. That's where they need to kind of get listed. And as a result of this provision, we see in fact a lot of flight of capital or talent to other geographies like Singapore and all, where entrepreneurs actually think of or deciding to set up the company only outside India so that they can list abroad easily.
Umesh, I will add one more point. I think the India's IP ecosystem, intellectual property IP ecosystem, can improve a lot because many of the companies like to domicile is either in the United States or Singapore.
True.
Because the IP protection is stronger and better actually. With so many technology-based startup companies coming out of India, I think the IP ecosystem has to evolve much better actually.
Yeah, thanks, Chin. That was nice.
I would like to request Vaibhav Kapoor to go ahead with his question.
Hello, everyone. First of all, I would like to thank all the panelists for such an insightful and an enlightening session. So the question I wanted to ask is that will the coronavirus make venture capitalists invest in diversified sectors, or will it contract the horizon to a lesser number of sectors than the pre-COVID level?
So Umesh, maybe I will take that because we do early stage funding. I mean, we are the first port of call for a lot of startup entrepreneurs. Yes, coronavirus has changed a lot of rules. There is changes in behavior, work, as well as lifestyle, and that has impact on business. So, suppose today someone comes to me and says, I want to do a travel business, fund me. Obviously, you won't get someone to fund at this point of time. That doesn't mean in the long term it's a problem. Embracing technology for work from home. There's so many changes. Consumption patterns have changed. All these patterns have changed. So, obviously the world is never going to be the same. Even after we have COVID virus behind us, COVID crisis, pandemic behind us, it's not going to go back to what we were pre. It will remain somewhere in between. And that is what one has to figure out, what is that stage it will be, and try and look at those businesses. So there is no shortage of ideas. There's no shortage of new startups which are coming. But is it the same as pre-COVID? A lot of them are same. A lot of them are different. Some sectors which have been totally battered, obviously they have to pivot themselves. But then there are some sectors like edtech, edutech, all these sectors which are doing exceedingly well. So it's a different world, exciting world, and only opportunities will only grow.
I would request you to read the book by Peter Diamandis, Future is Faster. Okay, so it throws light on several opportunities that are accelerating towards us right now. Thanks.
I request Niharika to go ahead with her question now.
Good evening. First of all, I'd like to really thank all the panelists. A lot of us have been inspired into thinking about our own ventures at this point. But coming to the question, so I have twofold questions. The first one being that given the fact that the FDI norms have been tightened recently, what kind of an impact do we see the international venture capitalists when we are talking about the inflows that would come into India otherwise? That being the first part. And secondly, given this circumstance and the tightening of these norms, how do we see the exit strategies of these VCs changing in the future? So this is primarily my question.
Sanjay, you want to take this?
Yeah, sure, Niharika. Yeah, the first one on the FDIs, yes, there are, and I will not name, there are, couple of, biggies already sitting on the cap tables. So yes, it does pose some challenge, for the new startups and, also the existing startups which are in ever cash burn mode to sort of easily get that Chinese capital. Definitely, at least our fund level, I'm seeing a lot of, activity or action there, where we already have sizable Chinese investment. So yes, that is definitely at least a short-term pain point, both for existing startups as well as new ones. Now coming to on the second question was on the exits. So I guess as far as these FDI change in FDI regulations are concerned, I guess I don't think that it has any direct linkage, with the FDIs. So while government is concerned about giving the majority control to Chinese investors, I mean, I don't think so there are any restrictions are being imposed on the exits as such. But having said that, the another trend which I have seen of late is, many of these Chinese investors are looking for exit avenues. So already, there is a lot of action on that front.
I would like to just add over here, Niharika, is that if you read the regulation today, it doesn't prohibit Chinese investment. It basically, in fact, it doesn't even say China. It just says that India sharing borders with any country, the money cannot come in from there without prior approval. So while government has kept that window open that you can still go for the approval route and get the money in. And I know I've been dealing with a lot of Chinese funds as well. There are activities happening where investments have been approved and they have approached the government with a request to approve these investments. However, there is no set procedure for these. Nobody knows timelines around this. So that's definitely a challenge. Another thing which Chinese investors are trying to do, or the other investors are trying to do, is to route the structuring through US and some other countries which obviously don't share border with India. And that's how I believe we Indians by nature are very enterprising. I'm sure definitely the workarounds here will also be found As of now, there is some pain, but which is more mental. I don't think industry is slowing down at all. And I think there'll be ways found going forward as well.
Thank you so much. Thank you so much.
Thank you, Sanjay sir and Mitesh for answering that. I request Saurabh Yadav to go ahead with his question now. Saurabh, do we have you here? Okay, I'll move on to the next question. We have a question from Akansha from MBA06 batch. So, Akansha, would you like to ask the question now?
Good evening, everyone. First of all, I'd like to extend my thanks to all those panelists for such an informative session. So my question is, as Nitesh sir said, that one should not focus on funding, but developing a sustainable business model. So according to a venture capitalist, what are the key qualities of a sustainable business model that a
But I
venture
guess
capitalist looks
Akansha is
into?
not audible properly.
Akansha, there's some disturbance from your end. Would you like to send a message?
Oh, am I audible now?
Yes, you are audible now.
So my question is, as Nitesh sir said, that one should not focus on funding, but on developing a sustainable business model. So what, according to a venture capitalist, what a venture capitalist looks into for a sustainable business model? How do you evaluate a sustainable business model?
Mitesh, do you want to take it?
Yeah, sure. So basically, Akanksha, sustainable business model is basically where your growth is not dependent on the next sort of funding coming in, right? I remember this very famous saying that congratulating an entrepreneur for raising fund is like congratulating a chef for procuring vegetable to prepare his dish, right? Ultimately, the funds are going to come in and that is going to help you create a business. It's not an end in by itself, right? So creating a sustainable business is somewhere where you're not dependent on the next dose of capital for your growth. There is an inherent strategy in place and you keep going from strength to strength. There is a complete misnomer where people feel that the early stage startups cannot make profit, right? They have to grow and they have to be inefficient in the shorter run, while the general answer may be a yes, because they are developing the business model. Monetization might help later. That doesn't mean that they should lose sight of the monetization. Personally, for us at IPV, whenever we evaluate a startup, it's not about are you being profitable today. It's about, do you have sight of profitability, and do you have sight of a good unit economic business where the fundamental questions around who's going to pay you the revenue, how are the expenses going to be, and at what point of time you are going to make money. If you are able to answer this convincingly, that's something which is enough for us.
Thank you, sir.
Thank you, sir. Now I request Harsheen to go ahead with her question.
Good evening, everyone. So, Chenu sir, you talked about the requirements that, if someone wants to get hired to a startup. But as a general question, so what do you think are some of the glaring mistakes that the startup entrepreneurs make that ultimately leads to, the non-sustenance of their ventures? So I think this question might help someone if they're looking forward to having their own venture in the coming future.
Sure, very interesting. Okay, am I audible? Just want to make sure. Okay. So I think, I think some of the questions some of the answers came from Nitesh. So actually, if you look at startup, the sustainability, unit economics, and also your vision. So that's what I was telling in the beginning of little earlier in the conversation. You should have an idea approximately. It may or may not pan out. So when you do a startup, 3-4 years down the road, who is likely to acquire it, right? Then you have to work backwards. Because I think some of the panelists mentioned, any good idea gets replicated within a couple of years, actually. So you should know where you are going to sell your company, or if you're going to IPO, then you should know who are your competitors. And then your roadmap should make sure it is addressing the gap, correct? The second thing is, so that is to make sure that you're not in a place where it is too crowded space, actually. Because often I have seen entrepreneurs don't look at it. I think one of the panelists mentioned everybody puts, they are the best in the top quadrant, actually. So that's I have seen that pretty much most of the companies, they come and tell, I'm in the top quadrant and everybody else is not there actually. So you have to be very cognizant about the competition. That is very important actually. You have to keep an eye on it. And like I said, that you have to know who is likely to likely to acquire you. The second thing is, like there is a misnomer again that you take a lot of money and quickly grow. To some extent, it helps, but I think you have to keep an eye on the unit economics. Your business has to be sustainable in the long term. Even if you take money to grow, you have to keep an eye on the unit economics and profitability. If not today, maybe down the road actually. So the common mistakes I have seen the entrepreneurs making when there is a pivot, like for example, right now we are in the middle of the COVID actually, and certain sectors are more impacted, like hospitality sector and travel and so on. So if you are impacted, you have to quickly pivot. You have to be nimble enough to move actually, because you have to, the ideas, whatever you think today, 2 to 3 years down the road may change, the market may change. You should be receptive to that and you should be nimble enough to change. Actually, that's where I have seen a lot of companies losing out. They stay too long thinking that, you have to understand that you have only certain time window actually. Within that, you have to make it. You have to understand your competition. You have to look at who is likely to acquire you or go for IPO, or you will be merging. So people who don't look at all these things, they lose out actually. The other problem I have seen that is promoters not gelling well. If promoters don't gel in the midway, then it is another problem. I have seen that. That's why we look at the promoters' background. Have they worked in the past? Do they have complementary skills? These kind of problems happen a lot actually also. There are many other things, but I think these are the primary things I can think of. And I'm sure other panelists also can add actually.
So if I may add just one point, I tell startup founders all the time, don't fall in love with the product, fall in love with the customer. Most of the times startup entrepreneurs come and are so much in love with the product. I tell them, be passionate about the product, but fall in love with the customer. Don't fall in love with the product. That's it.
That's it.
Yeah, Chinu?
Yeah, well said actually, because I have seen many engineers, they fall in love with the product. They lose sight of the commercial. So it's an important point actually that you should keep focus on customer. Customer is very, very important actually.
Thank you so much, sir.
I'm sorry, I just dropped off for a minute and I missed the question, but whoever's listening, I think please write down what Nina just said. That is pure gold. Because the moment you stop growing is the moment you start dying. That happens as a person, it happens as a business. So your product is never complete. Just focus on that.
Thank you, sir. I would like to request Shantanu to go ahead with his question now.
Hi. Thanks for the wonderful session. I really loved it. Sanjay, you were talking about calculating the market size. You were saying that when you fund startups, you look at the market size that they are trying to capture. So how do you calculate the market size for a product that is non-existent? Maybe almost in all the startups, what happens is they come up with some product that has not existed before. So how do you calculate the market size for that? And I understand that there are a few methods with which you can approximately calculate the market size. But even if I calculate that approximate market size, how do I convince my investor that this is the actual market size?
So I guess this is more, I think, a question to probably Chinu and Ninad, because we are basically a scale-up fund. So for us, that way it's easier to calculate, because as I was saying that, when we invest, there's already a sizable market. So would any one of you like to take that?
Yeah, I can take that.
Yeah, go ahead, Chinu. No, so I've seen a lot of pitch decks by startup entrepreneurs. There's not a single person who has not shown me a large market size. They calculate it. Then it is our job to figure out how they've done it. So it may not be a research paper you have, but let's say you're doing an operating system for batteries to be put in electric vehicles. There's ways of doing it. There's no scientific way. It is not taught in your IIM school. It is not taught in engineering school. But there are ways in which you can have a logical way of finding it. You can, we can discuss in detail, but it is possible. If you're not able to even show the market size and say, this is new, I don't know the market size, it is not possible. Everything you say, remember, everything you tell a VC has to have a metric, everything. So you have to figure out, it can be through a logical method in which you can certainly do. So over to you, Chini.
Just extending what Umesh said. So actually, I always, early stages, the way you assess the market, it is how you navigate in India traffic actually. So you know whether your vehicle will fit in or not. So it's a guesstimation. There is some science to it, a lot of guesswork is also. It comes with experience. But the other way of looking at it is also you triangulate. You talk to people in that sector, 2-3 people. So then you try to triangulate actually. And like it will not be like a series B stage or C stage where you can pinpointedly say this is the market, but you should have a broad idea. This is what the market is evolving actually. And as long as you have that, that is fine. And the assumption, you have to make a lot of engineering assumptions. That's what.
So one simple rule of thumb at times is, what are you replacing? If your product doesn't exist in the market, what are you replacing? How big is the market for that? So as saying, triangulate. If as a founder you're finding the logic of your own business difficult, how do you expect to convince somebody else that your business actually has a logic?
And just to tie to the previous question, I think Harshin was asking, one of the failures I have seen, not every business is a VC model or investable model actually. Probably some of them are lifestyle businesses. It may have a steady growth. It may not have the scale what investors are looking for. I have seen many companies, they grow steadily and they end up being a family business. That is also okay. So at least you should know whether it is a scalable business or not scalable business. Many times entrepreneurs fail there also, not knowing the difference.
Oh.
Thank you. Thank you.
If I may just take 1 minute and add over here, I know maybe we are speaking like a broken record here about market size, but I have a slightly contrarian view over here. I think sometimes we give too much of importance to market sizing. Only one example that I would like to give is, did Jio ever think about market size being the largest player in the country? No. Reliance is expanding every day because they are adding the market, because they are creating the market. Especially at early stage, the entire market is your size. I mean, while it's good to have that number, some telltale sign of the overall triangulation of the market, but I think if the solution is right and you are reaching the right market, I think sky is the limit. I admire Reliance and Jio for that, the way they are pushing boundaries and creating the market for themselves.
See, another example of perhaps using imagination for estimating the market size would be in the 1980s when Starbucks was launched. Okay, coffee was the product that human beings consumed for more than 400, 500 years. I don't know how many years. Okay, so anybody who would launch a coffee brand, okay, any investor would say, what is in it? I mean, what is so great about it, right? But the whole experience was about experience, right? And experience is an intangible that resides in the human mind. And then it is your wildest imagination how you make that experience as a commercial product, okay? So I guess there are challenges in estimating, but nevertheless, you need to run your imagination wild and try to have some logical pegs to arrive at a number, okay, in a range, because you cannot precisely pinpoint how much is it, but given the right circumstances, you could peg a range saying that from this to this possibly is a market if I do it right, the right kind of experience for coffee drinkers, okay? So yeah, that's about it. Nothing further to add.
Thanks a lot. Thank you.
Thank you, sir, for answering this. Now we would head towards the last question for the evening from Saurav again.
Good evening, sir. Am I audible?
Yeah.
Okay. So first of all, I would like to thank you all for the insightful discussion. So my question is related to the sustainability of the startup models. If we look at few listed companies in the US, such as Uber, WeWork, we find that even after so many years of operation, they are still not profitable. And recently, even in India, for the benefit of startups, the government has allowed foreign listing. But there are certain players who actually look at sustainable business models. My question is, do the listing of these unsustainable models motivate others to follow the same suit, or what is their take on this kind of unsustainable business models getting listed and achieving higher valuations?
I just like to kick this off here. We very often make this very interesting assumption that sustainability and immediate profitability are linked. Sustainability is over a horizon. Profitability is also over a horizon. You've heard of a company called Facebook, right? Took a bit of time before it started earning money. But when you have a billion people on a platform, when you have a billion people on your platform, when you're the world's third largest country, as it were, the dimensions of sustainability are different. We tend to get really carried away with our preconceived of what constitutes sustainability. The larger, sorry, go on.
Sorry, Amitabh, go ahead, please complete.
No, I was just saying that the larger a business grows, the bigger is its horizon. You've got to see whether it is able to generate and push cash back in. If it still needs money, that's fine. How much of the cash that it's picking up is it putting into growing, and how much is it putting into working capital? Those are some of the things that you need to look at. Companies can make losses for 10 years. It doesn't matter if they're still growing. So, mentally look at what is the logic with which this business is going. And please understand, it's very easy for a lot of people to sit back and comment that this investor didn't know what he was doing. Guys, these are not punters, they're informed punters. There is a difference. They play numbers, they work probabilities, and everybody's going for a big win. So if you're not seeing it yet, maybe change your lens before you decide that this is profitable, not profitable. But on one point, you're right, don't blindly copy. You may not be seeing what the other guy is seeing. Look at your own picture, see what you can make of it. Sorry, Sanjay, please go on.
Yeah, you sort of, just to build on what Amitabh said, I guess, so there is no one size which fits all. You will see, both types of companies who have access capital, from the public markets. If you talk about just to give you an example, the largest exit in the Indian startup ecosystem, one point in time was the largest cash burner, right? I need not name that. So, so it depends upon the business model. For certain business models, they are market movers, right? And definitely, they would need a lot more capital. But having said that, once they have established themselves, once they have emerged as clear leaders, slight change in the business model, the risk reward completely changes. For players, some of the e-commerce players, if they change their, take rate by 10 basis points, their unit economics will, look very, very different because they have huge set of users already on their platforms. So on the other hand, if it's, let's say, a enterprise tech company or a B2B company, the same logic might not apply because there the expectations, from the investors and from the public market is that, the profitability gets valued there. The multiple which you get over there is on the profit or the cash which you're generating. So it depends, which segment you are in.
Would just like to conclude by adding that a pertinent example here. You spoke about profitability and you spoke about valuation, increasing valuation. Do you know the price earning ratio of Tesla? The price earning ratio of Tesla today is 1000 plus, right? Does it make an unsustainable company? Does it make an unviable option? Answer is no. And that's where your answer is.
Thank you, sir. Thanks a lot.
Due to paucity of time, we have to stop the questions here, and I'm sure students can take up the questions later if the case encourage them on LinkedIn. Our heartfelt gratitude to the panel members for answering all the questions for the students of IIM Amritsar. The media and PR cell of IIM Amritsar has created a small surprise video for our guests, and I request the team to play the video now.
Thank you, MPRC team, for creating such a wonderful montage of this enlightening session. Now, I would request Mr. Praveen Kumar from Industry Interaction Cell to propose a word of thanks. Over to you, Praveen.
Thank you very much, Jill. Respected Director, our honorable guests, faculty members, and my dear friends, a very good evening to all. It is an honor for me to propose a vote of thanks on behalf of the Indian Institute of Management, Amritsar. We would like to thank our director, Professor Nagarajan Ramamurthy, for obliging us with his esteemed presence. We would also like to extend our heartfelt thanks to Professor Santosh Tiwari and Professor Chetan Chitre for guiding Industry Interaction Cell in this unprecedented situation to maintain the legacy of Pariprekshya'. I propose a hearty vote of thanks to all the panelists for gracing this event with their presence. We believe that this will act as a foundation stone for future collaborations. Thank you all for enlightening us with your knowledge and experience. I'm sure the students will benefit from this discussion and will reflect upon this. Furthermore, I thank our exclusive media partner, CNBC TV 18, for covering this event. We are also very grateful to our knowledge partner, Finalists, and the media members. I want to extend our gratitude towards the IT team for the smooth functioning of today's event. This event would not have been a resounding success without the seamless efforts of the Media and Public Relations Committee of IIM Amritsar. We also extend our gratitude to the Finance and Economic Club of IIM Amritsar for setting a relevant context for the event, and the Merchandising and Sponsorship Committee for their assistance. Last but not the least, I thank all the students of MBA 05 and 06 batch for their constant support, patience, and engagement. Without you all, this event would not be possible. Once again, thank you all.
Thank you.
Thank you. Thank you.
Thank you all. Thank you. All the
Thank
best.
you.
Thank you.
All the best, students. Thank you.
All the
Thank you,
best.
guys. All the best to you.
Thank you, sir.
Thank you so much.
All the best.
Thanks a lot, sir.
Thank you, sir.